Hey, Dan Passarelli here. Well, it has been a week, has it not? Little exciting up on the week. We weren't sure that was going to happen yesterday, but we had an inside day that ended up closing somewhat higher, almost a percent higher in the S&P 500. And that is all because we got the PCE inflation data, which came out saying that, inflation's still cooling, not so bad, right? And that gave a lift to the tech stocks that really benefit and are able to grow when they can borrow money at low interest rates. The assumption being that if inflation is low, the low interest rates might be coming our way sooner. But I wanted to talk about something different. I wanted to talk about implied volatility because, look, we look at the VIX, and the VIX is 13.33. Man, oh man, do you remember when that used to be higher? Because it used to be a lot higher for a long period of time. But now it's not. It's really low. It's really cheap now, right? Maybe not. Take a look at this blue line here, down here. This is the historical volatility. This is how much the stock is actually moving. Now, what implied volatility is thought to do is to price in the future movement of historical volatility. And ever since middle of April, implied volatility has been above historical volatility. Now, what does that mean? Well, what that means is implied volatility has been overpriced. Options have been overpriced since the middle of April. So are income trades dead? Well, no, not really. And in fact, that's going to be the topic of our Trade Smart workshop this week. You can always navigate over to the student portal and join the Trade Smart workshop if you're not already part of that. That said, hey, it's the weekend. Have a super great weekend. Do something fun. Do a little bit of financial research to get ready for the trading week next week. And I'll talk to you then. This is Dan Passarelli, Trade Smart.